Welcome to Investors Guide. Thank you so much for tuning in. I'm so glad you tune in week after week for advice, and it makes us really happy when we hear from you and you've written in saying that you've spent the last 7 years following advice you've heard on this show, and it's meant a great deal to both your money and to your portfolio. Well, over the next half hour, we're going to continue to give you that kind of advice. We'll start by helping a first-time investor begin investing in mutual funds. In our product review, we look at the IDFC Premier Equity plan, and we'll help you figure out what to do if you get a notice from the IT department. That's coming up later on the show. Let me bring in Dhirendra Kumar, the CEO of Value Research. Dhirendra, thank you so much for joining us on the show. Our first question comes in from 33-year-old Preetham. Now, he has written in with some very interesting goals, Dhirendra. He wants to save 14 lakh rupees for a car he wants to buy next year, 5 lakh rupees for an international holiday he wants to take in 2 years, and he wants a retirement corpus of 5 crore rupees in 20 years. He also wants 2 crore rupees for his children's education in about 15 years. Now, these are steep goals for anybody, but he sent us his financial details. Now, he has about 1 lakh rupees in coming in as an income. He saves 30,000 rupees every month. Health insurance taken care of, no term cover, and that causes me some concern. He has a Jeevan Anand and a Jeevan Saral plan and 9 lakh rupees in a fixed deposit, which a portion of which he treats as his emergency fund. So when we look at the goals that he wants to achieve, Dhirendra, there's the short-term goals of the car and the holiday, and the long-term goals, of course, of his retirement and his child's future. How does he separate? How do any of us really separate between short-term and long-term to make sure that what we want in the short-term doesn't impact our long-term goals?
First, he should, definitely look at his long-term goals and earmark a certain part of his savings towards that, and never get indisciplined about laying his hands on those savings. His long-term savings should not be touched for all times to come. And then the money which is left over, or the remaining money he will have the flexibility, and he should understand the worth of all this planning, because if he should seriously consider that the amount of money being spent on holiday, little bit saved there. What will be the worth of 1 lakh rupee today, 30 years from now? And that will do some job for him in terms of understanding the scale of money, the kind of compounding that happens, and how valuable that money will be at a point when he will have no income. Of course, without compromising a lot on his aspirations or his short-term likings or consumption needs. So he should scale down a little bit there, be considerate about it, and have the long-term plan, and he should never get distracted from that.
Right, never get distracted from the long-term plan. Dhirendra, the other thing that worries me about the funds that he's picked out now, the 30,000 rupees he wants to save every month, he's divided it across 11 different funds. He has 4 tax savers for himself. He's allotted to his wife 3 entirely debt funds, short-term debt funds, and of course, he's also looking at a mix of equity, diversified, mid-cap and large-cap funds. That seems a little haphazard. Is there a way to make it easier to organize and easier to manage for the both of them?
Yes, absolutely. I think, he should seriously consider not having more than 5 funds, or at most, maybe his job can be done with 4 funds. A tax-saving fund, a debt fund, for a substitute to his recurring deposit, no more than 1. That will keep it very simple, and 2 equity fund which can invest across the market, across all kind of companies. That should do the job, and I think he should resist the temptation of adding more, because when you have more funds, you lose interest, and they are not meaningful enough. And if you have 4 funds, you will be interested. They will have a goal, and you will make changes when things are not going as expected.
All right. And finally, Dhirendra, the Jeevan Anand policy, he's putting about 52,000 rupees in it every month. And he has another LIC policy. Would you like him to sort of discontinue payments into those policies and consider more efficient forms of investments?
Immediately. I think he should immediately go and buy a term plan and discontinue these policies. These policies won't be serving the need of a term plan or the scale of insurance he needs anyway. So that should be done immediately, and that money which he will be able to save on account of this discontinuance can well find its way into the same mutual funds.
All right, so if you need any more help, of course, you can back in touch with us. That's what we're here for. There's another very interesting question, Dhirendra. This one comes from Apurv Bhatt. He says he's going to start earning 40,000 rupees from next month. So he's already begun planning. He hasn't even made his first salary. And I think that's very commendable. Now, he wants to build a corpus of 10 lakh rupees for a car he wants to buy over the next 10 years and a retirement corpus of 10 crore rupees by 2050. He doesn't have term insurance, but he's part of his family's health insurance plan. And he has no assets right now and no liabilities. He wants to begin investing about 20 to 25,000 rupees every month in SIPs and put the rest of the money in the PPF or a fixed deposit. What would you recommend? All right, let's break this up one by one. And first, take a look at the goals. I think they're very commendable. And if he starts with his first salary, there's nothing really that he can't achieve. How would you like him to approach this, Dhirendra? He wants to put some money in equity. He's also considering the PPF. For someone that young, with such a long way to go, is the PPF a good idea?
No, PPF is not a good idea for somebody who is thinking even before he is going to get his first salary, and he can't go wrong. And if he's disciplined about it, PPF will turn out to be a huge drag on his returns because now we have started witnessing the decline in interest rate, and PPF return will be reset every quarter. So you can be assured that PPF will barely match the inflation rate, and his goal should be some. And at this stage, he must initiate a plan where he is able to experience the joy, how to access equity or how to invest in equity, and get over the problem which most investors face, that how to navigate the ups and downs of it. And I don't think there is any way around it except that you diversify and invest regularly by way of SIP. But I will give him a much simpler plan. First, he must have, he has no dependents and he has no liability. So all his income is disposable. Build your emergency fund. First 2 months salary, don't do anything. Make your deposit and have that 50,000 rupee, 1 lakh rupee, or whatever in your bank account, which is accessible through an ATM. That will give you a lot of confidence and courage that you will never be stuck for money. And after that, you start your, so do your saving, make a deposit, and that should be the first stop. After that, figure out what is your tax liability. Are you likely, if you're earning 40,000 rupees a month and an annual income of 4.8 lakh rupees, you'll be liable for paying some taxes. What will that entail? How much saving will ensure that you will not have to pay taxes? And so his first stop should be a tax saving fund to the extent that he will be able to save taxes. And he should not look further than this, beyond this. And remaining money, if he's left with any more money, then he should consider a general equity fund. So deposit, tax saving fund, and after that an equity fund, nothing beyond that.
All right, so just a recap of what Dhirendra said. First, create an emergency fund, then do tax saving, and then a normal equity fund. Now, on your screen are the aggressive tax saving funds that we're recommending for this year, and also equity multi-cap funds that you can use for this year as well. We're going to take a quick break. Dhirendra will stay with us. We come back and talk about IDFC Premier Equity. That's on the other side. Don't go anywhere. Welcome back. You're watching Investors Guide in ET now. Thank you for staying with us. It's time for our product review. And this week we're looking at the IDFC Premier Equity Plan. Amita will give us a quick introduction. Amita.
Thanks, Faye. This week we take a look at the IDFC Premier Equity Fund. With a good long-term track record, this mid-cap fund is not a new name for our investors. But how does the fund's performance stack up in the last 5 years? Let's take a closer look at the performance chart. Now, the red line is the fund and the blue line is its benchmark. You'll see that this fund's returns post-2010 has not been disappointing. With just about average returns, the fund has managed to perform better than its benchmark and category. However, you'll also notice that the fund falls short of its peers in the performance chart. In the last 1 year especially, there have been several other mid-cap funds that have had better returns than this fund. Now, the fund that used to be a stellar performer has now turned out to be just an average fund. The fund's rating even has dropped down to just about 3 stars on Value Research. Now, if you have this fund in your portfolio, is it time for you to switch to a better performing fund? Let's find out. With that, it's back to you, Faye.
All right, Amita, thank you for those numbers. Dhirendra, 3 stars on Value Research. But the thing about IDFC Premier Equity is that it's a fund of very high investor interest. It was recommended on this show, through the course of this show, for several years. Also, we have a lot of people who hold it in their portfolio who are constantly writing in to ask us about it. Now, 3 stars might be worrying for several investors. Should they be concerned about the fact that it's not a 4-star fund at this point? For those who are holding IDFC Premier Equity, do you recommend they continue to hold it, continue their SIPs?
Yes, it has been a relatively meddling fund for a while, but it has not been a very disappointing fund. But more importantly, the fund manager who ran a very unique strategy, or quite an unusual strategy. It's not a mid-cap fund by design, and of course it had carried a mid-cap portfolio. It was the best fund soon after it was launched. 2007, it was among the best performing fund. Of course, 2007, no Indian investor was disappointed, but 2008, it was just as good, was very resilient through that period. So it had its glory days, years, and phase, and it has and for a long period it had carried a very unusual portfolio, and it stood out. No longer. And there has been a fund manager change, and so it's very normal or natural for investors to be very curious about this or anxious about the performance, and they should be. We have, recently a new fund manager has taken, experienced fund manager from UTI has taken charge, or has joined the fund management, and is bringing about small changes, but no wholesale changes here, and he comes with a good pedigree, good background, impressive track record. So one should be watchful, but there is nothing to be worried about this fund, and it has a brief period of underperformance or not so impressive performance as in the past is always is disappointing for investors who have been used to some great period in the life of a fund, and it will be unreasonable to see a repeat of that. But there is yes, this fund has been on the performance count, I would say that it has been little above average, and it has continued with its mid-cap style. I haven't seen wholesale changes, so I would still give it a time. I would not like to write off this fund that, okay, it's not performing or it is too disappointing. I don't think it is a case of anything like that.
Well, Dhirendra, I'm going to put on the screen our recommendations for mid-cap funds for this year. This fund is not on that list. So my question to you is this: if there's someone right now who's looking to make a fresh investment, would you recommend the IDFC Premier Equity plan?
No, not at all. And looking at the other options, I think there are impressive options available. Besides that, one odd definitely is stacked against IDFC, that it's a very large fund for a mid-cap fund.
Dhirendra, finally, your rating of the IDFC Premier Equity plan, where would you place it?
As it has been in recent times, an average, a 3-star.
All right, 3 stars for the IDFC Premier Equity plan on Investors Guide. Remember, Dhirendra said if you're holding it in your portfolio, it makes sense to hold on to this fund. It has not been disappointing. But fresh investments would be better off in one of the lists perhaps that we've picked for mid-caps for this year. That's on your screen again. Let's move on to our hold or sell segment. Pushpendra has written in, Dhirendra, he wants to invest in mutual funds to save enough for his retirement. And I think that one of the biggest impacts that we've noticed over the last 7 years since we've been running this show is how many people are actively thinking about their retirement when they begin their careers or when they're in the middle of their careers. That's a change we've noticed in the mindset of investors across the country. Now, Pushpendra is looking to invest 25,000 rupees a month. He wants 50% of it in high-risk funds and 50% in stable funds. And he sent us a list of the investments that he has. He has a term plan. He has 2 ULIP policies currently, and he started investing in mutual funds. The Franklin India Prima Plus Fund, Dhirendra. Continue that investment? Yes,
this has been an old favorite, and it has still all the variables in place to remain one.
The next fund is also impressive, the Kotak 50 Fund. He has 5,000 rupees a month going into this fund. Continue this investment as well?
Yes, again, this is the kind of fund which one should have similar to a very broad strategy. Flexibility to invest across, yeah, and this fund has started to do, is beginning to do very well once again.
The ICICI Prudential Focus Blue Chip, Dhirendra, next on his list. Continue this investment as well?
Yes, this fund has been very impressive. And it follows, it's all embedded in the name. Focused blue chip means few large cap stocks that it will hold, and it has done exceedingly well. And going by what he has set out to do, this is another kind of fund which will help him achieve his goal.
He has the BNP Paribas Mid Cap Fund and the Franklin India Smaller Companies, along with two other emerging blue chip funds. He has a Mirae Asset Emerging Blue Chip and DSP BlackRock Micro Cap, Dhirendra. These form his mid and small cap exposure. He's only putting in about 10,000 rupees into these funds, whereas 15,000 rupees is going into the blue chip funds. Let's start with the BNP Paribas Mid Cap Fund. Continue that investment?
Yes, it has been an outstanding fund. He should continue.
Mirae Asset and Franklin India Smaller Companies, Dhirendra, they're also impressive performers.
Yes, once again, all the four funds, if one has to create a small cap portfolio, and the four funds, they have very little complementary position. So in that sense, including the DSP Black Micro Cap. So when I look at these portfolios, he has little overlap, and these four funds, but one has to be little sure of, one has to withstand the big ups and downs. If he has started in recent times, he'll be getting carried by the recent past performance. I'll just remind someone that these are the kind of funds which actually, in a declining market or when the markets turn around, then these funds actually crumble. In 2008, some of these funds went down by 70%. So when you see your 100 rupee going down to 30, will you still continue? Will you still have the time on your side? And so one important thing is that you should have an appetite for that those big drop in value. And the other is you still have time on your side. If you are making an investment for 3-4, you have just 3-4 years for a goal. And if this is your portfolio, then it is very undesirable.
All right, so that's the advice you're getting right now. And if you have further questions, of course, get back in touch with us. Our email ID is at the bottom of your screen. Dhirendra, we're running out of time, but quick question from 22-year-old Saurav Chakrabarti. He's written in saying he wants to begin investing in mutual funds. He wants to build a corpus of 2 to 3 crore rupees in the next 20 years. What funds should he invest in? He's a first-time investor, Dhirendra.
First 2-3 years, he still has a lot of time. First 2-3 years, it is important to get used to the whole machinery or the whole experience in a manner that he starts believing it. So first 2-3 years, I think he should choose 1 or 2 balanced funds from our stable growth portfolio, be at it, and then think in terms of upgrading himself to an aggressive growth portfolio or growth portfolio. And if he's unable to think in terms of a portfolio, then he should just start with one fund and be at it. Start doing his investment, not see the value for the first 1.5 year. Then it will be easy for him to be on a long-term investment plan.
All right, Dhirendra, thank you so much for joining us on the show and answering all of our questions. We've run out of time right now, but if you have a question for Dhirendra Kumar or a particular topic you'd like us to discuss, write in. Our email ID is at the bottom of your screen. You can reach both Dhirendra and me on Twitter. On the other side of the break, we'll talk about what you should do if you get a notice from the Income Tax Department. Don't go anywhere. Welcome back. You're watching Investors Guide in ET Now. Thank you for staying with us. We're going to take a look at tax problems. Suresh Surana joins us to answer your tax questions. Mahesh has written in from Bangalore. Now, he tells us that right now he's received a notice over financial year 2010-11 saying that he has an outstanding demand for 31,000 rupees against his name. He has record of the fact that he's paid all the taxes for that period. Now, he contacted his ITCPC and they've told him that the claim was made by the local assessment officer in Bangalore. He later submitted all of his returns and his 26 AS papers to the Kendra, but no action has been taken. He wants to know how he can sort this issue out. And the reason why we're bringing it up, Suresh, is that we know there are several viewers and several investors across the country who are facing this problem where they get a notice about, a tax year, several years gone by, and they're required to pull up all of those details and hand them over. How do they make sure something like this is sorted out?
One, obviously, the demand of 31,000 rupees. Unfortunately, you will have to approach the jurisdictional assessing officer for this, in order to carry out this rectification. What you can do is also submit a formal, written request in which you can attach the proof of the payment and your 26AS extract that this amount has indeed been paid. And thereafter, normally the jurisdictional officer will make the necessary correction. But if you just make an oral request, it may not be processed. It is necessary to submit the underlying documents based on which the credit can be given. So, the challan and 26AS extract and all those things, if you submit, I am sure the jurisdictional assessing officer will give you the credit for that.
Next question comes in from Roopchand. He tells us his brother-in-law gave a gift of 1.25 lakh rupees both to his wife and his son. He wants to know if there are any tax implications on him because of that. Well, technically, a gift between blood relatives doesn't, attract any tax. Suresh, obviously nothing to worry about there.
So, Mr. Roopchand, the gift received from specified relatives, which in this case it will come within the specified relatives, there is no income tax on that, it is exempted. You can reflect it in the schedule of the exempt income. So, whereby it will be just reflected as a piece of information, there is no income tax on that. Obviously, going forward, they will have to pay tax on whatever income they are earning on that gift amount.
Last question comes in from Sudhakar Reddy. Sudhakar wants to know how to save tax on fixed deposits. He says if he divides his 1 crore rupee liquid cash and invests in fixed deposits, 20 lakh rupees in each of his family members' names, what will the tax implications be? Suresh?
First of all, within the family members, you need to check if you are gifting the amount to your wife or to minor children, you will not be able to take the benefit because the clubbing provisions are applicable. But if you are gifting it to your children who are major, which means above 18 years of age, or if you are gifting to a parent, then they can claim separate exemption limit of 2.5 lakh rupees each. They can also, invest in section 80C various saving instrument and claim deduction of 1.5 lakhs. So, you need to check who are the family members where you will be able to, without attracting the clubbing provision, you can gift it to them. And thereafter, yes, definitely to that extent, it may not be all the members, but certain members of the family, you can take the benefit of this basic exemption and by gifting the amount.
All right, Suresh, thank you so much for answering those questions. That's a wrap on Investors Guide. Remember, you can get in touch with us on our email ID, or you can reach me personally on Twitter if you have any questions that you'd like to ask on this show. Thank you so much for watching.